Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a 5-time award winner of Dow and the Founders Award. He has the Risk On and Risk Off Exchange Traded Fund, the Junk On and Junk Off Exchange Traded Fund. He's also a mutual fund portfolio manager and the publisher of the Lead Lag Report. Michael Gaid, thank you for joining me again.
Always a pleasure, Jason.
So, Michael, we're recording this interview on Tuesday, August 20th, 2024. The gold price is well above $2,500. I think it hit $2,545 approximately in the last couple of days. It's been bouncing around there between that and $2,500. The 10-year US Treasury yield has dove down, but it's been a roller coaster the last 9 to 12 months. It's back down at around 3.8%. I want to get your thoughts on the macro cross currents because obviously you have a well-known risk on, risk off ETF. Have you seen anything like this in the last couple of weeks where it seems like we're about to go like severely risk off with what the in carry trade unwind, and then in the span of like 8 days now, it looks like we're about to go back to risk on with Fed rate cuts potentially, and the S&P 500 in the last 8 days is close to the July 2024 all-time highs again.
Yeah, it's funny, right? Everyone was high-fiving me on the reverse carry trade, from that August 5th Black Monday drop. And I myself then said, the fact that everybody's now high-fiving me probably tells me that it's time to take a contrarian view on it, at least from a path perspective. I said that day they're going to rally it and turn everybody bullish very quickly again before hitting it again. And, people are focused on me saying they, like, who's the they? They is the market, right? I mean, that's what the market does. And to your point, now everyone is suddenly all bulled up again. But it's actually playing out the way that I thought it would, which is Japan becomes a spark. People suddenly become experts in the reverse carry trade. The market then confuses everybody by rallying and making them think that the reverse carry trade is over. And then it turns out that the reverse carry trade was only one act in the play, which is still ongoing before the main event being the long-awaited credit event. I still think we're kind of in this, in general, volatile, high-risk period. I've myself argued that I think if anything hits, probably it's going to happen towards the end of the month into September. I say that purely because it's not my opinion. Typically, when you're in a high-risk period, utilities are strong relative to the market. Lumber to gold is weak. Treasuries are strong. Gold is strong. So you're now at a point where a lot of things are confirming that it's raining hard outside and the risk of an accident, at least in the short term, is elevated. People hearing that will then say, well, that just means you're a perma bear. No, I'm just trying to identify conditions that my own signals, which anybody can backtest and see, are themselves saying. This is a curious environment because you said it, in the opening, it looks like stocks are back towards the July highs. I'll shoot back then and say which stocks. So you look at the Russell 2000 small caps, they haven't recovered at all from that pre-carry trade dynamic. So maybe they will, right? But the point is there's still a lot more weakness and damage that's occurred despite, this VIX crush that's happened.
Yeah, I agree. They're the cross currents. It's the Mag 7, so the large cap tech stocks. But then you also have the risk off stuff. You have gold prices doing very well. The TLT trade, what the people going into long bonds, the 10-year US Treasury yields diving down. And then the utility shares have been on fire. I mean, I know you wrote articles on this telling people that utilities would be a good play. I don't know if you saw, though, that the utilities would get a huge growth kick with this next generation data center investment, CapEx boom for artificial intelligence, but they're going to be included in that. They're going to be a growth factor. Even Warren Buffett has been talking about this for the last 6 to 12 months.
Yeah, it's interesting. If you look at the TLT to SPY ratio, so basically treasuries divided by the S&P 500. Okay, so you'll see it's coming off of an extraordinarily low base. You had the spike, but it still actually looks like it could be an uptrend, meaning, we could still see another relative, jump in treasuries outperforming, being up more, down less, the S&P 500. That's why I keep going back to, I don't think this is over. I think this is still just beginning. You almost have to have people believing that it's over for it to shock, right, on the downside, which again, I think is still very much a likely scenario. On the utilities end of things, I think a large part of this movement is still not AI driven. I think actually the AI data center demand play seems to be more connected to nuclear specifically as opposed to the utility sector more broadly. Utilities and other dividend plays are, I think, we're still responding off of defensive demand as well as the reality that when you're faced with uncertainty and volatility, you probably want low beta.
Yeah, so this is a weird macro environment because you have some risk on and some risk off plays both doing well. But like you said, the real economy, which is the small caps, the Russell 2000, is not doing well. But the major indexes like the S&P 500 is doing well, although that's market cap weighted, right? So that's mostly Mag 7 and Nvidia.
Yeah, and I keep on saying small caps hold the key, and I've said this like so obnoxiously and repeatedly for the last year. And it's not me just trying to be cute about it. It's just you have two very different messages, and this has been the core issue for me, which nobody seems to care about. And maybe I'm the crazy one, but the small cap side clearly is saying there is default risk, there is credit risk. It's why these small cap stocks have been held back. It's why the Russell 2000 it had never crawled out of its drawdown from 2021. The market is more than just 10 names in the S&P 500. The market, there's many more small cap stocks than large cap stocks. So small caps clearly have been worried about credit risk. Meanwhile, credit has not been worried about credit risk. You can't have two different, but this is the core of the issue for me. And that's why I've stayed obnoxious and persistent on the thesis around credit event. You can't have the same dynamic, right? And the same factor, in this case, default risk, be priced in differently by small caps and then by junk debt.
Oh yeah, you're preaching to the choir. Like business television is talking about like the regular stock market indexes and everything spun positively about the economy, no real recession risk. The Fed's going to cut rates, the asset prices are going to remain elevated. Meanwhile, the headlines for a lot of the office buildings, you see pension funds, insurance companies having problems dumping these office buildings for all cash, like almost every single day. And you're seeing these Main Street businesses, like which are probably publicly traded in the Russell 2000. It seems like a restaurant's almost going bankrupt almost every single day now. These are restaurants that cater to the middle class that were at one point one of the top fastest growing small caps. There was another one today. I think it was BurgerFi.
Yeah, and the delinquencies are clearly rising. Again, it's like people will say, "Oh, you're a perma bear, doomer guy, doomer." No, it's like, no, folks, it's not me saying something is wrong. It's small caps saying something is wrong. You can't say small caps don't matter because people are automatically buying market cap weighted Vanguard funds in their 401k based on their salaries, which is based on passive flow, as opposed to what the real market, which is discounting the future, which is small caps, are telling you. It's. And again, nothing has changed. Now, you combine that with the fact that unemployment is rising, which, by the way, I'm pretty sure that brings with it credit stress, brings with it widening defaults across the country, okay, on the corporate side. Then, it's like, at what point do people start saying maybe the thesis actually has validity? They'll say it when it's too late. Just like when everyone was high-fiving me on the reverse carry trade. I've been on this thing since August of last year. People coming at me, attacking me, you're stupid, Japan has nothing to do with it. And then they all high-fived me. I got 14 million impressions in a single day on X. I then myself said they're going to rally the shit out of the market. They did, and then people were like, oh, you were wrong the last 2 weeks. No, you're not paying attention. And this is the problem with this market. Everyone is reacting off of the most recent data or the most recent price action. They're not listening to those that have a different perspective than they do beyond the last 5 stupid trading days.
Yeah, I agree. It's recency bias. And then a couple weeks ago, when the yen carry trade did start to unwind, I think what I saw, at least my impressions, Michael, and you can comment on this, it looked like there was margin calls for the yen carry trade, and then the margin calls spilled over into the leverage short volatility trade, and so people were selling their stocks, and that caused the big spike in the VIX from low levels. The VIX looked like it had been capped for over a year in the 10, 12, 15 range, somewhere around there, very, very low, and then we got a VIX spike up to 25, 30, and then it hit 66 intraday, and now it's back down to, I think, the 13 or 14 again. So it looked like we got margin calls in some of these really big over-leveraged trades, starting with the yen carry trade, and then margin call spilled over into a leverage short volatility trade too. And then both of them were smashed back down.
Yeah, and then look what's happened since. Everybody's now probably taking on the same trade that was working prior to July again. So you're back to the same bad behaviors because it didn't last very long. Now, the thing is, these things tend to have aftershocks. So to think that this is over, it's like it is maddening to me that people think that this carry trade dynamic, which has been going on, by the way, for like more than a decade, that people think that that's done in 48 hours. Like, are you out of your mind? I mean, is this it?
Well, did you
It
see
doesn't
what
make.
JP Morgan? JP Morgan's claiming that it's 75% over.
Yeah, the same JP Morgan that said, Bitcoin sucks and then creates a and then becomes a custodian for. Give me a break. Come on. Like this is ridiculous. So but at the same time, this is what's necessary for the market to screw the most number of people, which is what the market does, especially at extremes. It's not me being a perma bear. It's just I see risks here. And by the way, there have been plenty of times in this year where there were junctures where it made sense to be risk on. The difference this time around is that the treasuries are clearly acting differently. Okay, in other words, on down days for markets, you are seeing treasury prices rise and yields drop on the long end. So we are in a cycle shift. We are back, I think, to a world of risk on, risk off. The whole Phoenix rising, which I was dead wrong timing wise, thinking that it would have come back towards the end of last year, maybe because I desperately hoped it would, because my own funds live in that world. And I want to see that dynamic come back because that's what I built ATACX, RORO, and JOJO around. It's why I've had such a hard time the last 3 years. Maybe it was just hope back then, and I would that colored my vision, as I look back on it. But it does seem like that dynamic is back. The good thing is, if that dynamic is back, it should be easier on a go forward basis to stand out, to outperform, right? And that probably does mean gold also in sympathy will continue to rise. It probably means utilities will continue to outperform, that dividends make a comeback as they should, because I'm sorry, AI is nothing compared to getting a check, right, from a company that's well managed, that's been around as a blue chip for decades and is doing all the right stuff from a managerial perspective, as opposed to the FOMO trade, which is what this, still ongoing with Nvidia, obviously. So all this is positive. But it's going to be volatile. The one thing I have some degree of confidence in is that we're probably in a more volatile cycle that's going to throw everybody off bulls and bears, as I keep saying.
I also think that we've seen the last couple weeks of preview that there's just too many over leveraged trades on that, like a lot of portfolio managers at banks, hedge funds, family offices. Maybe they were borrowing from Credit Suisse in the past. There's probably other events out there. It looks like they could have borrowed too much from Japanese banks. And that with this yen carry trade, there's problems for both the lender, the banks that are lending out on the carry trade, and then also the borrower when there's too much volatility in the currency markets.
Yeah, look, I think in general people underestimate how much leverage there really is, and leverage on leverage. I mean, there's options on options effectively is what's going on. So that's why even the idea that the yen carry trade is done 75%. Are you kidding me? Like, how many derivatives there are on the derivatives that the yen carry trade has enabled? I mean, it just doesn't even logically make any sense at all. But either way, I'm going to go back to the core thesis. The core thesis is that credit is massively the pricing of credit doesn't make sense, especially with unemployment rising as it is. And because of that, especially and also with housing now weakening pretty substantially, because of that, you're gonna have to have a repricing, a re-rating of junk debt, which means small caps probably were right all along. If small caps were right all along, through them going nowhere for a year, then the good news is after that, there's going to be some incredible buys in the high yield junk debt space, but you have to go through some period of pain first.
And I also think that the Fed cutting rates, even 50 basis points, 75, it's not going to fix all the problems in commercial real estate with the regional banks, with the small caps. Like you said, the Fed would basically have to start slashing rates close to zero. And even then, I think a lot of these businesses have cash flow problems and rising input costs still.
Even if the Fed cuts by 100 basis points, so what? There's still lags. This is the thing which just drives me crazy in the way that people think. It's also why I never gave up on the thesis. We're still in the lagged window. People are so used to thinking things happen on their timeline. Their timeline is the last 5 days. It's the recency bias we just talked about. Give me a break. These things, the Fed doesn't know the lags themselves. They themselves admit it. So everyone's looking to Powell to be, the pilot that gets the soft landing. You know what? How every hard landing looks like a soft landing before it becomes harder. Every crash looks like a soft landing before the crash. It's like, because you don't know the lags. You don't know how long the runway is. You don't know how fast you're going. You're flying blind. And yet everyone's thinking, hey, you know what? Yeah, Powell did it. Powell did it because of the S&P. Well, what about every single other company beneath the S&P?
Yeah, I agree. I think the macro data and the government data for like GDP, the CPI, which is down below 3% now, I think that's very, very different than what the companies, a lot of these Main Street businesses for the consumer are reporting on their earnings calls for the last couple of quarters. Because I think they're showing that a lot of the customers are tapped out in a lot of cases, and they either can't pass on price increases or their sales are down enormously.
I mean, anybody that's listening to this podcast, ask yourself, like, can you comfortably take a vacation? I mean, can you actually afford to like live life, like and have fun and enjoy time off from work when prices are this high? I mean, it doesn't have to be a recession to feel like it because you can't do the things you normally could with your salary.
Yep, purchasing power loss. I think the accumulated inflation, even from like Trueflation data, I was listening to another the Adam Taggart channel with like Grant Williams, and they were talking about the Trueflation accumulated inflation. It's like 25% over the last 3 or 4 years. So there's an enormous accumulated inflation for Americans of at least 25% with the government data.
Yeah, but who cares, bro? Because it's all about the rocket ships and the S&P and the crypto and the big. Like, you can tell it's been a long day because I'm just kind of like unloading on the silliness of the way people think. Look, everything's a cycle. Everything's a cycle. This has been a very unusual cycle in that it's not co-moving the way it normally would, right? And you can argue that somewhat makes sense because you're dealing with the lags of the shutdown, the lags of the reopening, the lags of the stimulus, the lag of the fastest rate hike cycle in history, and now the lag of the reverse carry trade. And all these lags, nobody knows when they hit, but you're still in the lag window of all this stuff, which is why everything is just weird and off and uncomfortable and strange and disconnected. Typically, you know how you resolve disconnects and divergences? By correlating everything to one. You know how you correlate everything to one? With a crash.
Yeah, I was going to say bankruptcies and deflation, which is what free market force is. So the businesses that were disciplined, that didn't borrow a bunch of high interest rate debt and were disciplined, kept cash on the balance sheet, they could go buy the assets of the businesses that went bankrupt or go buy small cap companies or something like that. That's how things would in past cycles. But it just seems that there's even more distortions and more misallocations of capital. The macro cross currents with both some risk on entities and some risk off stuff both doing well. It's just shocking, but it seems like the middle, Michael, the middle class, the small businesses are being hollowed out. Whereas like, risk on and risk off, the barbell strategy seems to be doing well and everything in the middle seems to be getting crushed.
Sounds like America.
Well, it sounds like bad central planning from governments and central banks. I mean, if the government's going to spend $8 trillion and China and Japan aren't going to be net buyers of treasuries, well, you are seeing yields go down, but those other governments are voting with their trade surpluses and they're not buying treasuries.
Yeah, listen, I have used that line many times, and I was early or wrong or both, whatever last year, but it is facts that if you want to, get demand for treasuries up, you scare the ever-living hell out of equity investors. How do you scare the ever-living hell out of equity investors? With extraordinary volatility. You saw it not that long ago with the first warning shot of what happens when the carry trade gets reversed. It's not over.
Do you think then we'll see $3,000 gold in the next 18 months or less then?
Yeah, I mean, I don't like to think of things in terms of price targets, but do I think gold can surprise on the upside? Sure, because I don't think anybody's focusing on it. Look, I keep going back to this point. Uptrends live on skepticism, they die on conviction. I still see a lot of skepticism around gold. I still see a lot of conviction around Bitcoin. I don't know. I mean, I'm not trying to be contrarian for the sake of being contrarian. I mean, I get it. People see my funds not understanding that they run the same way if I die tomorrow, that it's not based on my thinking. It's based on rules-based approaches. They say, this guy doesn't know what he's talking about. Look at how he's done, totally ignoring the fact that I've had to deal with a hellish environment where I design funds for credit risk, not for duration risk, which is what really happened. Duration bear market as opposed to credit bear market. But I still have a lot of experience and knowledge and respect for cycles, and I just look at this environment and I say to myself, it probably ends badly. And then the good thing is that it'll revive afterwards. I never once said equities would go down hard. Somebody said to me on X, well, if you're going to be wrong, you have to be wrong within a reasonable time period, not 2 years. And the moment I said that, I reposted with a comment. I said, "Are you kidding me? Housing peaked in 2006. 2 years later, you had Lehman. This is how lags work." And again, just because it doesn't happen on somebody's time frame in the here and now, when everyone's attention span is shorter than a jellyfish, doesn't mean that the risk has gone away.
Oh, yeah, I agree. And if I remember correctly, from 2006 to 2008, there was a ton of extend and pretend games. So there were cracks. I mean, like there were hedge funds at Bear Stearns failing. So people like, oh, Bear Stearns would never fail. Bear Stearns has been around for way over 100 years. Lehman Brothers has been around for way over 100 years. The government will never let it fail. So I think there's similar extend and pretend games from that past cycle, and now it's in like office space and commercial real estate with the pension funds, the insurance companies, and the regional banks. And who knows? Maybe the Federal Reserve Bank is even already giving the Bank of Japan and what the Norinchukin Bank, the fifth largest Japanese bank, currency swap lines to delay out this yen carry trade unwind.
Yeah, maybe. Although I've said myself that I think that if part of this thesis is that this becomes the scapegoat for the Fed to really cut rates aggressively. The problem with that theory, of course, is that if they cut rates aggressively, it can oddly enough impact the reverse carry trade even more because it closes the differential of yields between Japan and the US, which makes the yen even stronger. That's why this is so tricky. I think people are massively underestimating the structural cycle shift that's gone on with Japan relative to everybody else and how that could result in so many unintended consequences from any policy action designed to try to counter it.
Okay, so this yen carry trade, if the yen, the exchange rate of the Japanese yen to the dollar, if it moves up or down too much, then you're saying that causes margin calls and problems for the lender and for the borrower?
I mean, that's how leverage tends to work, right? Because it's the whole point of this is that if the yen now there's some things that suggest that the shorting has now turned to speculative long positioning, which could be even scarier if that's the case. Now it's the momentum players are into the yen, but there's still probably a lot of leverage that's out there from the carry trade. But yes, that is the point. But again, I go back to the transmission mechanism around small caps is a volatility that Japan has sparked. And again, I don't think it's over. I could be very wrong. And if I'm wrong, I'm not going to apologize for it because you can say somebody's wrong with hindsight, but in the moment, this is about probabilities. The probabilities still look to be elevated to me.
Last question here. I want to ask you about Fed rate cuts and how that affects the stock market and how the stock market behaves in election cycles. So do you think if the Fed does cut rates here for the September meeting, do you think that would be bullish or bearish for the stock market?
Probably bearish only because look at every single time the Fed doesn't make, well, not every single time. There's two instances in history where the Fed cuts rates and it's not bearish, but the majority of time, when the Fed does pivot, as you've seen those charts, it's kind of an ominous sign for the bulk of a drawdown. It's actually really interesting because it's about the bulk of the drawdown historically happens after the Fed pivots. The key term in that after the drawdown, it means that you're in a drawdown, right? As the Fed is starting to pivot because they're starting to act off of something being broken. You're not really in a drawdown for the S&P 500. You're still very much in a drawdown for the Russell 2000. Because again, Russell 2000 has not overtaken the 2021 highs, even on a total return basis. So it is curious to me. It's like, well, if small caps are the real market and the Fed cuts and that's your proxy for what happens next, could the Russell 2000 suddenly itself be down, 25-30% again? Yeah, I don't think that's outside the realm of possibility. And then the question becomes, was this really a bull market or was this just an illusion driven by this AI narrative?
Well, I tend to follow the work of some of the world's best investors like Stanley Druckenmiller and Warren Buffett. And Stanley Druckenmiller has been selling a lot of the Mag 7, his shares. He's been taking profits on those, and he's been allocating what into dividend stocks, defensive plays, oil companies, which are low price to earnings multiples that pay dividends, and then gold miners. And then Warren Buffett has sold a lot of his bank stocks. He liquidated Wells Fargo and US Bancorp over the last couple of years. He just sold a lot of Bank of America shares, and I think he owns more 10-year, more long-term US Treasury bonds now than the Federal Reserve Bank does.
Yeah, I mean, I wish I were in that position. I wouldn't be happy to work as hard as I do, which is a reminder that I have to suddenly hop to do some more things here. But the look, I mean, again, nobody has a crystal ball on what comes next. Neither me, nor you, nor Stanley Druckenmiller, nor Powell. The best we can do is identify conditions, and I'll go back to what I said. I think the conditions are far riskier than people realize. And this is coming from a guy that said reverse carry trade, that everybody high-fived on the reverse carry trade. And as they were high-fiving me saying they're going to turn everyone bullish again very quickly before hitting it again. And from that perspective, you can look at that post, you can look at my tweets. That has played out. Everyone has turned bullish again, which is the perfect way to hit the markets right now.
So it sounds like you expect a lot more volatility in the bond market and also stock markets going forward then.
Yeah, I mean, the one thing I'm confident in is that stability breeds instability. So it's time to give birth.
Yeah, I mean, historically, like for our listeners out there who aren't familiar with what happened in 2018 and 2019, I mean, the VIX was basically dead too for years, and then you had Volmageddon. So, like Michael said to his point there, I mean, it was dead for years. It didn't do anything, and then when it did blow up, I mean, like there was funds that were literally failing, like banks and funds.
Yeah, I mean, whether it's that kind of a dynamic or not, I don't know. But I go back to markets will do what markets do to make fools of everybody. I have been made a fool. Everyone's going to be made a fool at some point.
Well, we did have the VIX above 30 though for a week or so. I mean, what, at 66, those are margin calls, right? So when the VIX is above 25, 30, it hits 66. I mean, those are margin calls for a lot of those over leveraged players.
Yes, and again, I believe it's unlikely that that's over. Could be wrong. I'm nothing if I'm not consistent and stubborn and annoying in my views. And if people don't like the views, then go ahead, be my guest, and go for confirmation bias. That's a surefire way of winning.
So please tell my listeners more about the interviews you do for the Lead Lag Report on your YouTube channel and your newsletter and your exchange traded funds.
Yeah, I appreciate it. So, I mean, the best way to access the research, which is meant to be thoughtful views on markets, as well as providing risk signals and high yield ideas, is leadlagreport.substack.com. I'm on X, YouTube, LinkedIn at Lead Lag Report. I have a podcast called Lead Lag Live where I try my best to interview other thoughtful people. I just did 2 earlier today, and always appreciate you, Jason, for your kindness and for having me on your program. So thank you.